Meet Mike and Adam, best friends. Both just bought the same house. $300,000. Same neighborhood. Same mortgage. Mike's plan? Pay off the mortgage as fast as possible. Debt-free in 15 years. Adam's plan? Keep the mortgage for all 30 years. Invest the difference instead. 30 years later, they compare their net worth. The difference? $773,000. Let's run the real math. The starting point, same for both. Mike and Adam both bought their homes in the same year. Same purchase price. Same down payment. Same mortgage terms. Here's what they both started with. Home purchase price, $300,000. Down payment, 20% $60,000. Mortgage amount, $240,000. Interest rate, for percent, 30-year fixed. Minimum monthly mortgage payment, $1,146. And here's the key. Both Mike and Adam can afford to put $2,146 per month toward their financial goals. That's the $1,146 minimum mortgage payment, plus an extra $1,000. Same monthly budget. Same $2,146 going out the door. The only difference? What they do with that extra $1,000. Mike takes his $1,000 and throws it directly at the mortgage. Extra principal payments. His goal is simple. Kill the debt as fast as possible. Adam pays only the minimum $1,146 on the mortgage. He takes that same $1,000 and invests it every month in a low-cost S&P 500 index fund. Same money, different targets. Let's see what happens over 30 years. Mike's path, pay off early. Mike is laser-focused. Every month, he sends $2,146 to the mortgage company. $1,146 covers the minimum payment. The other $1,000? Straight to principal. Year 1 through year 14. Mike watches his mortgage balance drop every single month. No investment account. No stock portfolio. Just one goal. Own his house free and clear. Mortgage paid off in 14 years and 8 months. Total paid to the bank, $377,500. $240,000 principal plus $137,500 interest. And here's the number Mike loves. Interest saved by paying early, $77,200. If Mike had kept the mortgage for 30 years, he would have paid $214,700 in total interest. By paying it off in 14.7 years, he only paid $137,500. That's $77,200 saved. Mike feels like a genius. Year 15. Mike's mortgage is completely paid off. He owns his house. No more monthly payment. This feels incredible. Now he can finally start investing. Years 15 to 30, Mike starts investing. The mortgage is gone. Mike takes the full $2,146 per month and starts putting it into an S&P 500 index fund. He invests $2,146 per month for 15.3 years at an average 8% annual return. Investment account value at year 30, $717,000. Mike's total net worth at year 30. House value, $300,000. Paid off, debt-free. Investment account, $717,000. Total net worth, $1,017,000. Over $1 million. House paid off. Zero debt. Mike is thrilled. Adam's path. Invest the difference. Adam takes a different approach. He pays only the minimum on his mortgage, $1,146 per month. That extra $1,000? He invests it every single month. For 30 years. Years 1 to 30, Adam invests from day 1. While Mike is paying down his mortgage, Adam is building his investment account, $1,000 per month into an S&P 500 index fund. He still has a mortgage. He's still paying interest to the bank, but his investment account is growing. Mortgage timeline. Paid off in 30 years, full term. Total paid to the bank, $454,700. $240,000 principal plus $214,700 interest. Yes, Adam paid $77,200 more in interest than Mike. This is the number that scares most people. The wasted interest. But let's see what Adam got in return. Investment growth. Adam invested $1,000 per month for 30 full years. Total amount contributed, $360,000. Investment account value at year 30, 8% average annual return, $1,490,000. Nearly $1.5 million. That's not a typo. Adam's total net worth at year 30. House value, $300,000. Also paid off at this point. Investment account, $1,490,000. Total net worth, $1,790,000. Adam owns the same house as Mike. Paid off, but with way more money. The comparison, Mike versus Adam. Mike's net worth, $1,017,000. Adam's net worth, $1,790,000. The gap, $773,000. Same house, same monthly payment, different strategy, $750,000 different. But what about that extra interest? Mike saved $77,200 in interest by paying off early. That's real money. But Adam ended up $773,000 ahead. Even if you subtract that $77,200 extra interest Adam paid, he's still ahead by $695,800. How is this possible? Two factors: compound growth and time. Mike had his money locked in his house for the first 15 years. His house didn't compound. It just sat there. Adam's money was in the market for the full 30 years, compounding the entire time. Mike was getting a guaranteed 4% return by paying down his mortgage, the interest he avoided. Adam was getting an average 8% return from the stock market. That 4-point spread, over 30 years, created a $773,000 difference. Why Mike's path feels safer? Here's the thing. Most people would choose Mike's path. And emotionally, it makes complete sense. Debt equals bad. Paying it off equals good. Simple, clear, safe. Mike got a massive psychological win in year 15. No more mortgage. No more monthly payment hanging over his head. He owns his house free and clear. That feeling is powerful. Meanwhile, Adam still had a mortgage for 15 more years. Still owed the bank money. That feels riskier, less secure. But here's what Adam was betting on. He was betting that the stock market would return more than 4% over 30 years. Historically, the S&P 500 has averaged about 10% annually. We used 8% to be conservative. Still, it's not guaranteed. Mike had certainty, a guaranteed 4% return, the interest he avoided. Adam had potential, an expected 8% return, but with market volatility. The hidden assumption that changes everything. Adam's strategy only works if he actually invested that $1,000 every month. If Adam kept the mortgage but spent that $1,000 on lifestyle upgrades, nicer cars, bigger vacations, eating out more, he would lose. Badly. He'd pay full interest with nothing to show for it. Mike's path forced discipline. The mortgage payment was mandatory. He couldn't skip it. Adam's path required discipline. He had to choose to invest every month and stick with it through market crashes. That's the real question. Do you trust yourself to invest consistently for 30 years? When Mike's path wins, the math favors Adam's approach. But that doesn't mean Mike's path is wrong. Here's when paying off your mortgage early makes sense. 1. Your mortgage rate is high. If your mortgage is at 7% or 8%, the math shifts. Paying down an 8% loan saves you 8%. The stock market might only return 8 to 10%. The spread is much smaller. The guaranteed return starts to look better. 2. You won't actually invest the difference. Be honest with yourself. If that extra $1,000 will just disappear into lifestyle creep, Mike's path is better. At least you're building wealth, even if it's slower. 3. You're close to retirement. If you're 55 and retiring at 65, you don't have 30 years. You have 10, maybe 15. In a shorter timeline, the guaranteed return of paying off your mortgage becomes more attractive. Less time for compound growth to work. Plus, entering retirement debt-free reduces your monthly expenses. That's valuable. 4. Peace of mind is worth more to you. Some people sleep better knowing they own their home outright. No debt, no monthly payment. That emotional security has real value. If being debt-free is worth more to you than an extra $773,000 over 30 years, Mike's path is your answer. Money is a tool. If debt-free living makes your life better, the math doesn't matter. The verdict: Mike's path is emotionally right. Debt feels like a weight. Paying it off feels like freedom. For many people, that's the right choice. Adam's path is mathematically right. If you have a low interest rate, a long timeline, and the discipline to invest consistently. Keeping the mortgage and investing wins by a lot. So which path should you choose? It depends on what you value more. Do you value certainty, simplicity, and peace of mind? Mike's path. Do you value maximum long-term wealth? Adam's path. But here's what you can't do. You can't keep the mortgage, spend the difference, and expect to come out ahead. That's the worst of both worlds. You don't have to pick one forever. Some people split the difference. They invest most of it, but throw a little extra at the mortgage. Not enough to pay it off in 15 years, but enough to shave a few years off. That's fine. It's your money, your timeline, your risk tolerance. The bottom line, if your mortgage is under 5%, you have at least 15 years left, and you'll actually invest the difference. The math says invest. If you won't invest it, or peace of mind matters more than wealth maximization, pay it off early. Either way, you're ahead of everyone doing neither. That's the real math. No opinions. Just the numbers Mike and Adam faced. That's $773,000 on the line. Same house, same payment, completely different outcome. If this changed how you think about your mortgage, smash that like button and subscribe for more real math breakdowns. And comment below, what's your mortgage rate? Let's run your numbers. Disclaimer: this video is created for educational and entertainment purposes only. The content presented does not constitute financial, investment, tax, or legal advice. All figures, calculations, and scenarios used in this video are hypothetical illustrations only and are not guaranteed outcomes. Past stock market performance does not guarantee future results. Individual results will vary based on interest rates, market conditions, personal income, expenses, and financial circumstances. Always consult a licensed and qualified financial advisor before making any mortgage, investment, or financial decisions.